Okay, very good morning to everyone. It's Wednesday the 15th of November. Hope everyone is well. And just in terms of an overview of what we're going to cover in the next 20-25 minutes or so, we're going to have a look at kind of general tone to this morning, a bit of a continuation of negative sentiment in response to some of the declines that we've seen in various assets yesterday, equity specific and oil in particular. We had a lower close on Wall Street. To give you an idea, we closed lower by about 0.25% in the S&P, a little bit more heavy in the Nasdaq, about 0.35%, and about 0.13 in terms of the S&P 500. But that's kind of crept through into the Asia Pac session and also then impacted the kind of general market sentiment for the European market open. We're going to have a look at a few different things. In terms of data from overnight, there has been a decent move in the Aussie to the downside following some wage data. There's been some Japanese GDP, and then we're going to have a look as well. There's some commentary which I've come across in the last 24 hours, which has been quite interesting, talking about equity prices and what have been at around these all-time record high levels, and then making sense of a bit of this kind of mild correction that we seemingly are having at the moment. And then we'll look at the day ahead, because today is very important. We have US CPI data, which is arguably the most important piece of US economic data. So that's what's on the agenda for this morning. So hopefully you can make a bit more sense of why this movement is occurring at the moment. And I guess encapsulating some of yesterday's news flow and movement, the euro was incredibly interesting yesterday. If you remember at the time, if I make this chart a little bit longer dated here, this is euro dollar, and this move, just one day, that was that entire move. We went from about sub a 117 handle, and we're at 118.50 this morning. It's a decent, nearly 150 pip move in a day on really not a great deal. There was at the time, very early, some decent growth data coming out of Germany, their GDP surprising to the upside, kind of fitting in step with some of the kind of positive numbers that have been coming out of Eurozone anyway. We were looking at, this is just to put it in some context, that circle here was the November 3rd high, which we were looking at the range, just given the fact that that level as well, matching up around some of the low of the price activity at the beginning of October. However, we busted through there. The obvious target, as we were discussing this time yesterday, would have been the kind of late October low. But again, straight through that level, and really now it's about identifying upside levels of significance. And R1 looks a pretty strong level today, and that matching up with the 25th of October high. Above here, you've then got the kind of a period of consolidation on the evening of the 19th, when we found some resistance, which is essentially the 119 handle. That also, if you go back, does have some significance over the period of September as well. So pretty decent level at coming up at R1, beyond there at the 119 handle, and then above the overall kind of October range high was at 119.19.5. So certainly if the euro continues to rise as it has done in the last 24 hours, these are for sure levels that I'd be watching with some interest. Potentially either some resistance, or watching, if we did get a break, maybe a potential classic long entry to follow the trend that's materialized, for then from this R1 pushing up to the 119 handle on those previous highs in mid-October, as a potential something to look at. And beyond there, obviously that October high. So euro definitely has been quite surprising. We obviously had the Fab Four speak yesterday in an ECB communications conference, but as we were expecting, nothing really was said. For those reasons we discussed, there's no real reason for them to change the script as far as their own individual central banks have communicated thus far, which makes sense. The other big mover, of course, was crude oil. Now, I was kind of hopping on and off the desk yesterday afternoon. I know I was talking to some of the stage 2 trainees. They were giving me half attention because they were busy monitoring the price of oil, and quite rightly so, because oil did see a breach of, in the afternoon, what would have been post the traditional NYMEX pit opening hours. We broke technically the low point that was seen from the prior day. We then stretched that move all the way down to really that initial lift that we saw back on the 6th, and that ran all the way down. It looked like a lot of this was driven by stops being run. I think when some of the more experienced guys, when you've looked at charts for many hours accumulated over time, then looking at the way the price movement is occurring and the way the ladder is moving is obviously very telling as to the type of reason why the market might be moving in the fashion that it is. Now we're going to have a look at some reasoning why fundamentally it might have weakened, but I think a lot of this was technically driven, stops getting hit, and that's helping exacerbate the move. And you can see that really defined by an example of this, that breach of that level at around 55.65. It would have likely have ran some stops there, and you can see that extension of that wick all the way down to that high that we're seeing on the 1st, and then it bounced all the way back up to that level, then the secondary push lower, and now you can see how this is technically playing out, because even though we've dipped again here last night, as we've recovered, we found resistance back to that same point of interest on the 1st, which was also around the low of the initial spike from yesterday. So 55.22 looks to be providing some degree of resistance here on this mild recovery that we've had. Albeit though, we are down 50 cents still on the session. So a couple things to have a look at here for oil while we're on the subject. And this is what the FT are looking at. And this was something which occurred yesterday. Oil prices drop in Asian trade after bullish IEA comments on US output. So there's a couple things here. So overnight, the IEA's predictions, this is Asia reacting to their report. The IEA predicted on Tuesday, of course, the growth in US oil output until 2025 will be the strongest seen in any country in the history of the crude market, making it the undisputed leader among global producers. And again, those of you will know the US has been okay, it's getting to a point of almost saturation, it seems, in terms of operational rig count numbers, but what we have been seeing is a pretty persistent catch-up of North American production comparative to that of more traditional places like Saudi Arabia or also the largest, Russia. And so what they're saying is that really, if we look ahead in the long term, it's only going to be 7-8 years time, the US will be that undisputed largest producer of crude on the planet. Not only this, their report also lowered 2018 demand outlook, cautioning that global market is likely to remain oversupplied in the second quarter. I was also hearing some source comments this morning that the Squawk was talking about that were kind of suggesting that Russia may not be overly still committed to this expansion of the OPEC, non-OPEC cut production deal towards the end of 2018. And so a couple things there from a fundamental perspective that would help explain a little bit of the pullback. The other thing that we've had, of course, this was overnight for those who would have already have seen it, but to recap, you had the API crude oil inventory numbers, so this kind of sets the scene for the DOEs later, and the crude headline was a build of 6.513 million. Expectations for a drawdown of about 2.5 million. So we've had an approximate 8.5 million miss, if you like, on the headline reading. So again, another kind of bearish signal on that perspective. That was the biggest build that we've had in API headline in about 9 months. Cushing, though, be aware, was the biggest draw in 4 months. So it's not a runaway, one-dimensional bearish report. Gasoline, though, was the biggest build in 3 months. That was a build of 2.4 million. Expectations were for a draw of 1.5 million. So on balance, you would say that this is a bearish report, but the Cushing number was more bullish in that sense. So definitely it's not a clean cut, but if you look at the way that the market reacted to when that data came out, let's have a look. If I shorten the time frames, if we can see 9:30, so that was yesterday's sell-off, and then 9:30 would have been here. So it acted as a trigger to break through those previous lows that we had traded during the afternoon just before Europe left the market. So the data, the way the market reacted, a fall of about 30, well, looking at that overall, was about a 50-cent entire move, but we have recovered and steadied. And this is quite typical consolidation overnight in Asia. So what's going to be interesting here is that obviously the market's seen some pretty distinct repositioning over the last 12 hours or so, and we've taken back a large portion of the gain that was seen through really when we broke out on the 3rd and then on the 6th of that week of November. We're back to that $55 handle. So be interesting to see how the numbers play out later. Obviously with the DOE numbers we get to also pick the bones of the US output figure, which obviously is key. So that was oil, hopefully explained in a bit more detail. Looking elsewhere and just quickly running through some things that have happened overnight. The Japanese yen, you'll notice, is quite a bit stronger already this morning. It did generally strengthen during the overnight session. Now this did come, of course, with the general moderate risk-off tone. Equities negative close on Wall Street, and also the performance of Asia overnight was lower. But we did also have this. Japanese GDP came out, I believe it was in line with expectations, 0.3%. Doesn't sound particularly fantastic, but when we're talking about Q3 GDP, actually it was 0.1 lower than expected, but the market's dwelling more or focusing more on the fact that this was still an expansion for the 7th quarter, as you can see here, in a row for Japan. Now that is actually the longest streak of consecutive quarter growths in Japan since 2001. So yes, it was a little bit soft, but in respect to the average over the last 7-quarter period, it's pretty much bang on average. So it's not shocked the market to the downside by any means, and people are just looking at the fact that Japan continues to grow, which is more a positive sign. So maybe that's also just helping some of that movement in the Japanese yen, and obviously the stronger the yen gets, consequently that tends to weigh on the Japanese exporters, which make up a high proportion of the Nikkei, which then typically underperforms. The other thing that has occurred overnight, just having a look, here is China commodity sell-off continues. Iron ore dropped nearly 5% overnight. Now this is quite important. We're going to look at some of the domestic reasons why the Aussie weakened overnight, but certainly this doesn't help the Aussie because of its close demand and trade links to China itself. But the reason that's being pinned behind this reaction in iron ore, which is obviously a kind of a base product in terms of industrial metals, so Chinese growth and demand is very critical to the performance of that particular metal. Obviously we were talking yesterday, we had industrial production, retail sales, fixed asset investment, all from China, which were just slightly, but were weaker than expected. So people are pinning the fact that this is a bit of a delayed reaction to that data having come forward. If we look at the Aussie specific news, this is what we had, was wage data overnight, and wages grew 0.5% quarter on quarter in the 3 months to September. However, market expectations were for 0.7%, so we missed by 0.2%. And in terms of the kind of data set and its ranges and typical, I'd say, deviation from the median consensus, a 0.2 miss is relatively large. And the Aussie did see a pretty decent move from overnight. Let me just bring my Aussie chart over onto the screen so you can see it and see what I'm talking about, which was this move here. So you can see the Aussie, there was this kind of decent level of support at the time from the last kind of day or so that we had, which was sitting around that what would be on the daily pivots, the S1 level, but the data more than enough of a fundamental reason for the Aussie to just plow through that level, and all the way down we found some resistance, although it's consolidated since, initially on the pullback to S2, and we sit still below there at the moment. So I guess, would we want to have a look at a short from S2? I'm not sure how comfortable I would feel with that, just given the fact the market's already repriced a decent amount. I think maybe I'd be more comfortable with if we got a pullback back up to S1 or even to the 76 handle, then S1, that would be a pretty strong level of resistance, I feel, up here. But again, it depends on how aggressive or conservative that you'd want to be in that approach, I guess. Okay, few things that I did see and I just wanted to cover which aren't so applicable for, I'd say, intraday to be able to make a trade decision, but certainly to make a little bit of sense of the current, let's say, fragility almost that we seem to be seeing in equity markets. I think one of the interesting things about the second half of last week is we had that all of a sudden, after the Nikkei hit a 25-year high, it basically collapsed on what most people were coining as profit taking. This then snowballed into the ASX having its biggest down day in about 10 years. Europe got hit, US fell, and we still seem to be seeing some signs of almost pent-up kind of the fact that we've had such low volatility for such a long period of time. History would tell us that at some point that trend has got to break, and it seems like we could be moving into that era. And so what I've had is a couple of articles which are looking at this very subject that I thought you guys might find quite interesting. So I'm just going to summarize it basically. So two different sides of the argument here. So Bloomberg are running a story about a top Asia fund manager, and he's saying that this stock sell-off is a time to buy. Now, we've certainly heard this as a familiar theme through 2017. This buy the dip mantra has been, a very strong and definitive trend that certainly has materialized and held true through the period of the last several months. The chap that they're referring to is called Alan Richardson, and he oversees a fund, the Samsung Asset Management Fund in Hong Kong, and it's got about overseas about $500 million in assets. So he basically has had a pretty stellar record, outperforming the rest of his equity fund peers. And what he's saying is that basically the correction that we've had has been a necessary byproduct of then enabling the market to see its next significant push on the upside. So this is looking at the MSCI AC Asia Pac Index, and you can see through the various phases that we tend to have a corrective period, albeit relatively small and short, before then it gets followed by the next considerable push to the upside. The interesting thing here, of course, is that when looking at this, the correction that has happened at this present point in time is actually the biggest one that we've seen out of all of these phases year to date. And obviously this is going to start to raise some eyebrows. But if you start looking at, I was looking at some of these market commentators that Bloomberg are citing, and they're saying stock investors are probably taking some profits off the table after doing extremely well. Market participants likely winding down towards year end. And of these various different market pundits, so let me just show you the graph that I was looking at. This was the one that I was just talking about in terms of the correction periods, and the size of the one that we're seeing at the moment is here on the right hand side. But the comments all fit on this side of the argument the same way. Basically, going into the Christmas period, people are booking profits. They've managed to benefit from this continuation of the uptrend in the equity market. So as they're starting to lighten their positions, you're starting to see naturally a bit of a pullback from those moves. Now, the other quite contradictory note that I saw was from Bank of America Merrill Lynch. So what they do is they have a regular global fund manager survey. So they basically send it out to lots of different fund managers to ask them a series of different questions. And the market sometimes looks at this as a way of getting an insight as to what are the bigger investors on the buy side thinking about current market valuations and activity. And they're actually saying in their survey, so this is from fund managers, that with a record high percentage saying equities are overvalued, even as cash values are falling, is a sign of irrational exuberance. November cash levels dropped to 4.4% from 4.7%, now the lowest since October 2013, and no longer a buy signal. So quite interesting here is that what they're essentially saying, there's a record high amount of people are now saying equities are overvalued. And actually, that this is a sign of irrational exuberance. By irrational exuberance, I could give you the more clear, definitive movement would be something like Bitcoin, going from 3,000 to 5 to 6 to 7 without actually any real definitive change, just the fact that people are just joining a trend. It's a heavily behavioral market, technically driven by many by contributing factors. There are fundamental reasons, but what's happening here is it could go to 15 to 20 to 30,000. That's when this irrational exuberance terminology would come in. The interesting thing they say here, though, is that they also cite risk taking at a record because of Goldilocks expectations. Now, I think this definitely holds true, and is definitely an underlying reason of why equity markets have been on such a phenomenal rise of late, and why actually I don't think we're going to see this massive correction in the market. Is my personal opinion. I think, much like the previous article, this is a necessary function of markets correcting for them to move higher again, and also the seasonality of coming towards year end and the Christmas period when it's typically very quiet makes sense from a managing of a portfolio sense, or for these window dressing, so to speak. Now, for those who aren't aware of what Goldilocks means, what they're looking at is that conviction in Goldilocks scenario contrasts with tumbling bear view of secular stagnation as a macro backdrop, adding that US tax reform expected to sustain or inflate the Goldilocks view. So if tax reform gets pushed through and we start to see actually then a net benefit result, let's say Trump implements some of his policies which helps fiscally, the point being is that monetary policy is likely to remain in a very gradual and slow fashion. You know, this is Jerome Powell, who's going to take over from the Fed, kind of encapsulates this idea of continuity of Fed's very cautious approach. And so what you've got then is still a relative low interest rate accommodative environment from a policy perspective, but also getting an improvement in the global economic backdrop, and also maybe enhanced by further fiscal measures. This then provides the perfect Goldilocks scenario in that respect. So just quite interesting though on a lot of these points, because it seems like we are at a bit of a tipping point where opinion is relatively split about the next moves, essentially, as we've come to these all-time record high levels of late. Okay, a few other points just to be aware of. This has definitely gone off the agenda of late, but it still is yet to be resolved. And the reason I want to bring it up today is because Angela Merkel, the German parties, are reconvening as coalition talks deadline is looming. And so essentially she needs to, of course, form a multi-party coalition government. This is where that phrase of Jamaican coalition comes from, with the CDU-CSU party teaming up with the FDP and the Greens, is the ambition of Angela Merkel. But one of the important things here is that should talks fail, Merkel's options forming a fourth government are likely to narrow, because of course the German Social Democrats, who she governed with in 2013, as we know, have said that they're not willing to enter a coalition with her again. But essentially, if she cannot put together a coalition government, there is a risk then, technically speaking, that you could have fresh elections. Now, probability of that is probably very small, but it's something that I just wanted to bring about as an idea. And holding another vote is obviously very risky if there were to be another election, because if you'll remember from the federal elections in Germany, the most successful party in terms of a percentage increase in popularity was actually the AfD, which is the far right party, of course. And generally speaking, any further popularity of that side tends to be read as a negative outcome in terms of how markets are quite sensitive to those issues. Okay, looking at the calendar for today, just to wrap things up, you do have some important UK economic data coming in about half an hour, that being the latest wage data. So you'll see here you have your claimant count rate, your unemployment rate, the average earnings is what's particularly important. And the reason why I want to point this out is because, let me have a look at the unemployment rate here. This is the unemployment rate in the UK. So as you can see here, the unemployment rate in the UK is not an issue in comparison to the unemployment rates that we've seen historically. Now, if you look at where we are at the moment, we are certainly below levels of unemployment that were seen pre the financial crisis. And also, we are at levels now, really, we haven't seen since going back to what would be, I guess, the late 70s, early 80s. So it's not so much about people having difficulties finding jobs. The problem is people getting paid more. And so, obviously, in the environment of where UK inflation, as we saw yesterday, is tracking at 3%, the average weekly earnings growth is currently tracking at 2.2%. So there's a disparity here of which the cost of living is increasing, and this is putting pressure on households. Now, this figure is going to be the key one to look out for. 2.2% has been fairly consistent here. Looking at the expectations, we are expecting a slight decrease on the 3-month year-on-year reading, but a slight increase on the ex-bonus figure. So these definitely need to be watched if you're looking at the sterling currency this morning. Otherwise, the main event today, undoubtedly, is the US CPI figures. Now, these are very important because this is really the linchpin of what the Fed will do going forward. Now, as we said yesterday, a US interest rate hike in the federal funds rate in December is now priced at about 97%. But what definitely is going to be key is a summary of economic projections from the Fed and the press conference from Janet Yellen, which will come at the same time in mid-December, as to what is the outlook going forward. Now, CPI is definitely pivotal in trying to understand what the Fed might and their guidance might be going forward. Now, just bringing up US core inflation, because this is really the key reading to look at. This has been 1.7, you can see here, for some time. So certainly comparative to the peak at 2.3% we had at the beginning of the year, this is what's made it very difficult for the Fed to alter and become more hawkish, because of this relative weakness that we've seen in this area, which has kept them on a tightening cycle but a very slow pace. Now, a couple of things here from Deutsche Bank that I wanted to just quickly mention. They do note that US CPI has missed expectations 6 out of the last 7 times. So it, generally speaking, has been on the downside if it has surprised. The 1 month where it didn't, it was in line. So in the last 7 readings, it has not exceeded market expectations. More often than not, has disappointed. But, as you'll remember, the US PPI numbers came out last night. Well, not last night, yesterday afternoon, and they were stronger than expected. Actually, the October PPI, 2.8% year-on-year, was the highest since February of 2012. So whether or not this is going to act as a bit of a precursor is going to be something that's going to be very interesting to see later. Now, the most key point here to be aware of, and that Deutsche Bank pick up on, is an inflation inflection point. Now, what they mean by this is that over the last 20 years, US inflation has lagged GDP by around 5 to 6 quarters. So they think that a lot of the misses this year can be attributed to weak growth seen at the back end of 2015, early 2016. The stronger growth seen in the US and globally post the second half of 2016 should start to impact inflation soon. So actually what they're saying is, and this is probably along the lines of what the Fed are thinking, is that inflation is going to come because we've already seen growth pick up, and technically there tends to be a time lag, and then inflation does emerge because the economy has picked up and net demand has increased. So definitely this is going to be an interesting event, but I think that context is quite key, and if you were looking at it that way, I guess you would be saying that, well, actually for the Fed, maybe they don't need to be so worried, because if this holds true, then they're on the correct predefined course at the moment. So that's going to be a really big, interesting read, and certainly what you might get is the markets might start to quieten down ahead of that figure, because that's going to be ultimately key for the direction for the rest of the afternoon. The DOE oil inventories will come, usual time 3:30, and of course we'll use the API as our reference, not forgetting alongside the US CPI you also get US retail sales. Now, trying to jump in and trade US CPI and retail sales and hit the market in immediate fashion is incredibly difficult, because the probability of you or the probability of the economic data series all coming out pointing in the same direction, i.e. all much stronger or higher or lower, weaker than expected, is very unlikely. When it comes to retail sales, not only have you got to account for the actual figure release of October, but potentially there can often be serious revisions to the previous month. So the multiple of different data coming out all at the same time makes the market more often or not see a high degree of volatility initially. My advice would be to be prepared, and only if really you get an outlying directional altogether data sets in the same way will you get a much more cleaner move in the market. Otherwise, there will probably be much more opportunity later once the market picks through actually what it is that they're going to focus on if the data is mixed. So just a bit of caution around 1:30 when those numbers come out. Okay, going to leave it at that. So UK data coming up in about half an hour. Keep an eye on the upside on the euro. A couple of key levels coming up. For one, we're pretty much at there now. This R1 in the euro dollar pair, I can see it's just crept up to that point here in the top left hand corner. So all the best for today. Good luck with the data. I'll be in the chat room if you need any assistance. Thank you very much.